Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And welcome back. Another interesting week in the market. A lot of calls here, a lot of volatility. That was pretty interesting. Looks like the Brexit, maybe not such a big deal after all. In fact, market ended up almost where it began. That's why panicking is not a good option. Don't panic. There's never a reason to panic. And the reason that people panic is because they don't have a plan or they're not familiar with the plan that they do have. And I can tell you, as an investment advisor, I have people that call, they go to cash. They go to cash at times that are really bad when they're watching the news. And then they miss the rebound, and they lock in those losses. That's the most important thing, because to lock in those losses, to try to make that back, is going to be incredibly difficult. In most instances, it's going to be impossible to do. So, you got to have a plan, and the plan does not have to be complicated. That's the one thing that I'd really love to be able to get through to everybody. Your plans don't have to be complicated to be successful. In fact, the simpler plans tend to work out better. Simple plan does tend to work out better over time. So if you have any questions regarding what kinds of plans you might need to have, feel free to call us. We talk about it here every week on the radio. We're going to be talking about taking income. That's a part of a plan. How do you generate income from your portfolio? Especially with interest rates that are so low, and you don't want to get trapped into an investment that's extremely risky because it had a higher than average dividend yield or interest rate. I don't know if you read the Wall Street Journal this morning, but the Saturday morning edition, they were talking about Lenders Club. That's the online website where people lend money to people to others, and a company actually, it's kind of like, well, it's not really an online bank, but it acts a lot like an online bank. Anyway, they're having problems because so many of the loans are delinquent. To be expected. That's to be expected. So what are the higher interest rates that are available out there? 2%. That's the higher interest rate that's available. 2.5%, if you're willing to go out 30 years on a government bond. And those are the guaranteed rates, by the way, the guarantees that you can rely on. Now, they don't have credit risk because the federal government can print the money and just hand it out. They have other types of risk, interest rate risk, inflation risk. Those are different types of risk, but they're very real. They're risks that a lot of people don't think about, or they get to a certain point in their lives where they just would rather not think about it, and so they block it out as if it doesn't exist. Not really a good way to handle that problem. So anyway, we're going to be talking about ways of generating income from your portfolio. And that workshop is Saturday morning, August 13th, 8:30. Go to my website, bullingtoncapital.com. You can sign up. There is no cost to attend. Seating is limited. I think we have room for a little over 100 there. But anyway, should be a good time. I think there are a lot of things that you can look at that can help you increase the amount of income that you're getting from your portfolio, and at least be aware of the risk that you're taking. That's how you manage risk, incidentally, as you try to become aware of the risks that you're taking. Not to block them out, not to ignore them, not to pretend as they don't exist. You have to be aware, cognizant of the actual risks involved in the investments that you're making. And, I guess when you've been doing this as long as I have, it's not that difficult to do. There are a lot of things you have to learn along the way to get to the point where you can say, hey, I can evaluate that fairly quickly. And I don't think it's much of a risk. Or at least I'm comfortable taking the risk I am taking, and I know what kind of risk I'm taking. And that's the tough part, because in our business, the money management business, the best con artists in the world preside. That's where they are. The best con artists in the world are in the money management business. And you've got to be careful. You've got to be able to read through or read between the lines. I'll give you an example. I'm reading Wall Street Journal this morning. They're talking about this big private equity fund that was set up, and it's only available to certain investors. You actually have to have over $1 million in financial assets. That's what the SEC has deemed as someone who is an accredited investor, and otherwise known as a more sophisticated investor, which I think is kind of funny, because their assumption is that no one can accumulate $1 million unless you're pretty smart. Obviously they've never been to an NBA basketball game. A lot of millionaires running around out there that don't have a lot of financial education. I'll just put it that way. So anyway, these accredited investors are all investing in this fund. The fund's down 70%. It's a private equity fund. And this is one of the debacles. We've talked about it for years here. I need to go through and pull up to see if I still have the domain name, my GoDaddy account, nobodylistenstomeme.com. That would be a great place to kind of put this kind of stuff, because I know we've talked about this on a radio show multiple times. And so I'm going to talk about it again today. In fact, maybe I'll write about it this week and put it up on my blog so that people can see, go back and refer to it from time to time. Because we've been talking about this for a very long time. Private equity funds, they're sold to very wealthy people, the accredited investors, people that have over $1 million in financial assets. And they feel special. We're going to set this up and we're going to invest in things other people can't invest in because they don't have access to it. And the fund managers are going to share the profits that they're going to make. By the way, it's very similar. I think they got the idea from watching Berkshire Hathaway and Warren Buffett, because that's kind of how he runs his company. We'll go out and buy companies, and the cash flow that we generate from those companies, the profits that we generate, we'll actually share with the investors, or we can reinvest it and try to buy more companies and basically grow the value of that fund. Here are the conflicts of interest in that type of strategy. See, a private equity fund means they're investing in private businesses. Those private businesses do not have a price on them the way that General Electric does every day. You can get a price on GE's shares every day because it's traded on an exchange. You can't get a price for the shares of the business that you hold privately because there's no market, there's no exchange putting a price on those shares. And this is where it gets interesting. The manager, the guy who buys the companies to put in the portfolio, is also the person who determines, and not the specific individual, but his company, determines how well that investment is doing without the benefit of having a public marketplace put a price on it for them. So they're estimating what they think that business is worth. And incidentally, their management fee is predicated on how well or how poorly the fund is doing. Can you see the conflict there? You give me your money, I go out and invest it, I come back to you a year later and say, hey, look, on top of my 1 or 2% fee on the assets that you gave me, the business grew by this much, and so I think it's worth this much, so I get an extra 20% of that growth. Let's say the business value increased 10%. I think it went up 10%. So I'm going to get 20% of that extra 10%. That's 2% on top of the 1 or 2% I got from the management fee. I'm getting 3 or 4%. And you have no way of verifying anything that manager said. No way. Because it's not publicly traded. They don't have to file with the SEC. They're going to come up with general accounting standards. And you know what? If the GAAP, generally accepted accounting principles, actually were capable of fairly valuing, and if that's what everybody used all the time, then an index fund would be your best investment and everybody would get the same returns. It doesn't work in the real world. So, and if you have an option of, and by the way, there are lots of options in GAAP, generally accepted accounting principles. They have lots of options of how they're going to present the material. So which options do you think they'll choose? The ones that might be super conservative or even show penalties, or those that are going to put the best foot forward showing the maximum gains, especially when their compensation depends upon the gain. And that's what I'm talking about. That you're basically hiring a fox to watch your hen house. That's what you're doing. Maybe he's a good fox. Maybe he's can resist the urges to go in there and raid that hen house. Yeah, but all other things being equal, wouldn't you rather hire a person to do that, or something without a conflicting interest in doing something like that? Maybe put up some security cameras. I'm being facetious, but I think you get my point. You hire somebody to do a job, and you want to make sure that other people are actually seeing. See, that's what a mutual fund is. A mutual fund is run by a manager who goes out and invests in publicly traded companies, and you can see exactly how well or how poorly they're doing because they have to publish their holdings. They have to report to a board of directors on a mutual fund who gauges the money manager's expertise in selecting companies, listens to what he's doing, why he's doing it, how he's doing it, and can see the results. You can see everything. So that, in my opinion, is a much better way of making investments for the vast majority of people. Now, yeah, if you know the money manager of the private equity firm or a family office, you know them personally, and you trust them, you think they're good people, they're above board, yeah, that can work out, no doubt. But how many people literally know the money management or the money managers that are being employed for them? And see, the thing about this is, because it's restricted to people who have a lot of money, nobody really feels sorry for them when they lose their money. Nobody feels, well, they have a lot of money anyway. Not a big deal. And quite frankly, that's the prevailing sentiment. Nobody really cares. But I got to tell you, there are other reactions that happen to this. Those people that do have a substantial amount of money, that have invested in one of these private funds, then end up losing a lot of money, having a really hard time getting rid of the fund. That's the other thing. You want to get out of one of those things? Good luck. That is incredibly difficult. You've got to go and locate a buyer. Very similar to selling a house. You got to go try to find a buyer. But the difference between selling a house and this is everybody knows what their local real estate market is like and where they can list the house if they want to. You can go to forsalebyowner.com. You can hire a realtor. Lots of things you can do. You have a pretty decent idea of what the other houses similar to yours have sold for. When you go to sell a private investment that you really don't know much about, think about it. Where do you go? What kind of exchange is there? There are some exchanges out there. I'm not sure how good they are. The exchanges were actually put together by people who have a lot of money. We're looking to make money on their deals. You think they're going to give you exactly what they think it's worth? Probably not. So you're stuck. You're stuck. Bad idea. And this is how it affects the average person. Because companies like Google, companies like Apple, companies like Dell Computer, they were started by private equity firms. So the more poorly private equity firms do, the less people over time are going to want to invest in them, and the fewer Googles are going to arise as a result. You see what I'm saying? So it is a problem for everyone. It's a more immediate problem for people who do have a lot of money and are investing in those things. You just have to be careful. You just have to be really careful. It's very difficult. Private equity, I'm just not a real big fan of, and it's a big deal now. I've seen people in my office, they're just hardworking people. They saved a lot of money. They saved a huge chunk of their income their whole lives. They've invested their entire lifetimes. They've accumulated a little bit over $1 million, some close to $2 million, and they're being offered these deals as if they're, this is much better than the stock market. And I got news for them, and I know they want to hear it. They want to hear it. They want to believe that it's true, and in some cases it might be. However, It's going to be a long shot. How many minutes do I have before break? About 2. All right, I got about 2 minutes before break, so I'm going to go to Dennis in Parma. You have a question regarding the oil refining stocks?
Yes, Bill, I wanted to ask you about a couple companies, Marathon Petroleum and Valero Energy. What you thought of those stocks? They seem to be, price seems to be down on them right now.
Yeah, I would have to, since I've only got about 90 seconds left before commercial break, I'll tell you what, I'll write it down, I'll take a quick look at it, and then have some idea when we come back. And the first thing I would tell you is oil prices, you probably already noticed, are a little bit volatile.
Yes.
Like a lot volatile. So I'm not a real big fan of being a long-term investor in those types of businesses or those industries because they're too hard. It's much more difficult than, say, a company like Hershey's, who just turned down a bid that was big premium over what the company was selling for.
Yeah.
Chocolate's easier to predict than oil is, the price of oil. Now, it's not super easy, but it's easier. You know what I'm saying? Yeah, people who eat chocolate probably don't binge one year and then eat none of it the next year. But oil prices fluctuate wildly, and it affects the consumption rates. It affects car sales. It affects an awful lot of things. So it's a lot harder than a lot of other industries. That's what I'll tell you. When we come back from the commercial break, I will have taken a look at them and can talk to you about that. But I think I've got actually.
Okay, I'll hang up and listen then. Thank you.
Okay, well, thanks. Yep. And all the oil companies. Now I'm trying to remember. It was Marathon and oh shoot, I can't remember the other one. I'll my board operator has it. Okay, I'll take a look. I probably won't have to have time to look at more than Marathon now that I think about it, because realistically, to do this in 60 seconds or so is pretty difficult at best. And what I really look for is something that's that really sticks out. And when you're looking at individual companies, that's one of the things that you really need to try to do, is to look for those things that really stick out. If you have to take more than a couple of minutes to evaluate a situation, it's probably too hard. And what I mean by that is there are an awful lot of things that can affect the fair market value of a company. And so if those things aren't present right off the bat, the most important things aren't there, then you just want to go on to the next one. Anyway, I heard the music. That means I have to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned, because I'll be right back. Back. Yeah, how do you like that music? I really like it a lot. So anyway, we're all music from the 70s this week. Probably going forward, one of my favorite time periods in the music industry anyway. And I was pretty young during that time period, but I like it. So anyway, I'm going to go to Marathon and looking at this, this is kind of what I was talking about. So you look at a company. The first thing I look at is the revenue. Do they have revenue? That's kind of an important thing. And I know people are probably tired of hearing me say this, but I've had this up on the websites over the years multiple times. I'm going to put out a little white paper and maybe even a super short video on it. You'll be able to get online, download it. Actually, I'll probably just put a little course together. Anyway, this would be part of the course. The first thing you need to know about a company is, do they have revenues? Second thing you need to know is, okay, if they do have revenues, then that's a go. If they don't have revenues, my suggestion is go to the next company. Go to the next company. There are lots of companies that already have sales. It's when you don't have sales, you don't have a business, you have a business plan. And yes, some of them are going to work out, but it's so far between and so infrequent that you're better off ignoring companies that don't have sales yet. And will you miss one every once in a while? Yes, you will. You're going to see something that goes up, speculation. A lot of biotech companies come to mind. A lot of companies that make medical devices. Everybody's so convinced that they're going to sell billions of dollars. Drug companies, they're going to sell billions of dollars worth of their goods and or services, that the share price goes up. And the company's selling for billions of dollars and they have no revenue. I can tell you that does not work out well very frequently. And I'm understating how infrequently that works out. It's just not that common. So the first thing I want to look for are sales. And of course, Marathon's been around for a long time. They have a lot of sales. Now, interestingly, I go to Y Charts, which I think is a phenomenal service. If you're really going to be an investor, I would recommend you make the investments, about $40 a month. At some point in time, I'll have a link up to my website. You can sign up for it, get a free trial. But the data there is cleaner than the other data I've seen. And I've got a Bloomberg terminal that I pay an arm and a leg for. And I check the data on Y Charts first. So the Bloomberg does a whole bunch of other things that Y Charts doesn't do. So that's why I need it. But anyway, I look at the revenue, and I just cheated a little bit. I looked down, and I saw that they did have, I know more, I can't speak today. I know Marathon Oil has had revenue. That's a huge company. Okay, so that one, I know they've had revenue and profits, so I don't have to worry about that. I just went right to the revenues to see how steady those revenues actually are over time. And looking back at it, they must have been divesting some businesses. They had to have been. Because back in 2008, they had $86 billion in revenue. $86 billion. Over the past 12 months, the 12 months ending in March, actually that's their most recent quarter, the revenues were only $5 billion. So I can't imagine that the sales have dropped from $86 billion in 2008 down to $5 billion. However, that's a little disturbing. So I would go and I would look, if I really liked the company, that's the first red flag. Why were they doing so much more business? And my guess is that they've sold some divisions. So it might not, when you take that into account, their revenues from the current operations they have may not be that much lower, although they've got to be somewhat lower because the price of their main product, oil, is down significantly. So that's the first thing I look at is revenue. Next thing I have a tendency to look at is what is the company selling for today? If you took the share price, $15.68, and you multiplied it by the shares outstanding, which isn't right here, but anyway, you get the number. You're going to get the value of $13 billion. So if you had $13 billion, that's essentially what the company's selling for today. Actually, the value of all its stock, if you bought every share, that's what you'd be paying. And that's actually about 2.6 times higher than their revenue. 2.6 times higher than their revenue. That's a lot. That's actually more than the average S&P 500 stock sells for. However, if oil prices do rebound, those revenues, if oil prices went back to $100 a barrel, their revenues would probably double just on the fact that oil went up to $100 a barrel. Now, all you have to do is figure out when oil is going to go back over $100. Good luck. So this is what I mean about a company that's too hard. It's too hard. The dividend yield, by the way, this is not in the energy sector in the dividend model that I run because the dividend yield's not high enough. That's what I like about my dividend model, the one we're going to be talking about at the seminar that's coming up Saturday morning, August 13th. Go to my website, learn more about it. We're looking at dividend-paying stocks to generate income for your portfolios, actually to generate total return. You'll know more about that at the workshop. Total return is something that most people should be focusing on. Total return, that's what's the appreciation plus the dividend. If you don't have a dividend, all you have is appreciation. That's fine if you're young and you're really aggressive and you're going to invest in fast-growing companies, hopefully, that are retaining most of their earnings and reinvesting them. But the vast majority of people who have accumulated money are generally older and are looking for a combination of things. Income. By the way, that income that you get, it helps your return. It's generally about 40 to 50% of the total return of a portfolio like that. The fact that it has some tax benefits is also very nice. We're talking about that as well at the workshop. Just go to bullingtoncapital.com, click on seminars. You can sign up there. It's very easy. No cost to attend. Seating is limited. I think we typically cut it off at around 100. So it should be a lot of fun. And we're going to be talking about these subjects. How do you look at a stock? By that time, I will have the rest of the paperwork done. And again, I've done these over the years. I just don't have one current that's up on the website where I've shown you how to go through and try to get an estimate of what a company should normally sell for if you have an interest in that sort of thing. And if you don't have an interest in it, it's going to be 5 minutes anyway that we're talking about, because this is relatively simple. Does a company have profits? Yes or no? I'm sorry. Does a company have sales? Yes or no? If it's no, go on to the next one. There are several thousand stocks to look at. You won't be able to get through all of them, especially if you spend all your time looking at companies that don't have any sales yet. Bad idea. Anyway, next thing you want to look at, have they ever earned a profit? If they've earned a profit, what's the average? What's their average profit margin? Because those are the two things, all other things being equal, those are the two things that are most important in a company's valuation, sales and profits. So if they don't have profits, find out if they've ever had a profit. Again, I just go to Y charts. I see going all the way back to 2003 what the profit margins are. And the profit margins are all over the map. One quarter, they had a 64% net profit margin. They probably sold something, a division. In 2014, same thing, 40%. That's probably where they're selling off assets, because your profits don't fluctuate that quickly if you're not. Anyway, and then they go to a minus 55. So plus 64 to minus 55. That's not too volatile. I'm being totally facetious. Hopefully you get that. For me, I'm done. I've seen everything I need to see. I'm not interested in further exploring that company because the sales appear to be in a long-term downtrend, and the profit margins go from plus 60 to minus 55, which, by the way, was the last quarter that they had reported. Minus 55%. So they're digging into their cash. Not really interested. That is extremely highly speculative, despite the fact that it's a big company. A lot of big companies go away. Anybody remember Kmart? How about Bristol-Myers? They end up selling a whole business to another company, and they'll just for the name. The same people don't work there. They don't sell the same products they did. The only thing that remains is the name. And that happens all the time. I bet none of you remember Compaq Computer. Compaq was the number 2 PC computer manufacturer in the world at one point in time. In the world. So, gone. And you can go down the list. There are tons of them. Remember Enron, one of the oldest, biggest utilities in the world? Gone. Okay, so that's what I mean. Don't make this any harder than it needs to be. That's what I like about having a set strategy for investing. You got to know what you're going to do before the market does what it's going to do. People are calling, well, what are you doing about the Brexit? Well, I'm doing the same things I always do. See, because if it's not the Brexit, it's something else. There are always going to be instances of instability. Something's going to go wrong somewhere. That's one of the effects of having 7 billion people on the planet. Somebody's going to hit the wrong button. No. Occasionally, things are going to go bad. So if you didn't already know ahead of time what you should be doing when the next Brexit comes, when the fallout from the Brexit comes, when Greece's fallout comes, when Spain's fallout comes, when people stop paying their mortgages, which happened in 2007, 2008, if you don't know what you're going to do in those instances, you do not have a plan. You need to get a plan. It does not have to be complicated. In fact, the simpler plans have a tendency to be much more effective. Much more effective. But you got to get one. It's just like budgeting. That I've struggled more with that in the last 2 years because people calling me up saying, look, I want to retire. Can I afford it? And I'm like, well, how much in financial assets? Well, I don't want to tell you that. Oh, really? That's like going into the doctor and say, doctor, you can't ask me a single question, but I'm sick. I need you to heal me. Yeah. It can't be done. It's just not, or the answers that you're going to get are not going to be very good. So you got to have some idea of what your asset levels are, and you got to have some idea of what kind of income you might need. And the last thing you need to get an estimate of are any other sources of income. It's pretty easy. Assets and income. That's what it comes down to. How much income are you going to have in retirement? How much in assets do you have? Now, there are safer withdrawal rates. And here's where the big problems are coming in. They're not taking this approach. They're not taking a look at what we have to work with and saying, okay, now what kind of lifestyle can I afford given the amount of assets and income I have? And instead they're saying, well, I need this. Market doesn't care about what you need. It really doesn't. Instead of saying what you need, and typically those are things that you would like to have, just focus on what you have and how to build a lifestyle around that. That's what you got to do. Just do your best. One of the reasons I keep coming with a 5% withdrawal rate. 5% withdrawal rate is an average. Should be somewhere between 4 and 6%. We're going to talk about this in detail at the seminar because I'm finishing up one of the courses from the registered, I forgot what it is, RICP, Retirement Income, certified professional. And it's through the American College, and it's focusing just on retirement planning. So both the accumulation and decumulation phases. The decumulation phase is pretty tricky these days because the interest rates are not high enough to support what most people like. If we had a 5 or 6% CD, it would make my life a lot easier. 5 or 6% CD would be wonderful. And I hope they come out with those products that have those guarantees. They're not here. There aren't even 4% guaranteed products anymore. Not by a government agency, anyway. And a government agency, that's where you get your strongest guarantees. You get a AAA bond. AAA bonds aren't even paying 4% anymore. Not unless you're willing to lend them money for 60 years. And those are hard to find too. That's amazing. I mean, it's just amazing when I look back over my career and I think how low interest rates have gotten. And I'm pretty sure if I had told people that was going to happen, they would have laughed. They would have laughed. And we really didn't, back when interest rates, I remember when they first came down to 8%. Down to 8%. And people were, crying and screaming and, wailing, gnashing teeth because they were going from a 10% interest rate down to an 8% interest rate. And now today, you're looking at less than 2%. 10-year Treasury right now is 1.4. The 30 years down to 2.22. Wow, that's changed in just the last week. It was 2.5 last week. So 30-year interest rate down to 2.22. Those are your guarantees. Anything above those interest rates, there's risk. And the risk is minimally a credit risk. So what do you do in this environment if you're looking to make your money last as long as you do? That's what the seminar's for. There are things you can do. The Bullington Capital High Dividend Model, I like it a lot. That's why I use it, by the way. And incidentally, it's funny. People ask me a lot, have you ever heard of XYZ Fund? Yeah. And you know what? Half the time they don't believe me, so I'll actually have to pull it up on Morningstar or Bloomberg and say, there it is. And if I haven't heard of the fund, it's probably a variation on one of the major themes, because the major themes are actually not that numerous. The number of funds are, there are 60,000 some odd funds out there, and there are only a handful of things that they can actually be doing with the money. That's what people don't get. We've got this report through Morningstar where we pull up the mutual funds, and it shows the holdings and how much overlap there is in the holdings, and it's hilarious. People, they think that they're, I've only got 1/10 of 1% in the XYZ stock, really, because you have these funds, and they all have it in the funds, and according to Morningstar, at their last quarterly filing that they had with the SEC, you've actually got 5% of your money in that one stock, which is really not that big deal, but just surprising to an awful lot of people that there's overlap in their stocks. And that's one of the reasons I do the things I'm doing, Bullington Capital, things I talk about. I have access to all those things. I can use any of them. It's Department of Labor rule that came into play just here recently. Now you have to do what's in your client's best interest. Really? Yeah. So you had to make that a law? Anyway, I got to take a real quick commercial break. You listen to Bill Bullington right here on 1420 The Answer. I'll be back after these messages.
We had joy, we had fun, we had seasons in the sun.
And we're back. Hey, I think I'll dedicate this last section of the show to talking about some individual stocks out there. Yeah, I still like to trade a little bit on the side of a small portion of my account, which I think is a good idea for just about everybody. And these are not investing accounts; they're actually trading accounts. It's kind of a mix between the two, though. And we'll talk about that a little bit later. Right now, I got to take a phone call. If you'd like to call in, 216-901-0945. And I got Daryl with Alternative Income Sources.
Good morning, Bill.
Hey, how you doing?
I'm better than I deserve. Thank you. How about you?
Oh, probably the same.
You sound good. You sound good.
Oh, thanks. Appreciate that.
Yeah.
So you're going to talk to us.
I heard you talk. I'm sorry. Go ahead.
Oh, you're going to talk to us about generating alternative income. I have an idea of what we're going to be talking about, but I think that is absolutely a great idea, something that people need to take a look at. What did you have to say about it?
Well, as you know, I work with a company that's been in business for 60 years, some really top quality products, and there's an opportunity with that company to market them from a small mini office home outlet. All people need is a computer and a printer and an internet connection, and very little investment. There's free training involved. All they have to do is check out a free website that will give them some details about it, and they can make an analysis themselves. Obviously, there's no obligation. If that's something that you think you'd like to put out there for
sure, yeah,
your listeners.
Yeah, give us the website address.
The website is Nutriskis.com.
And that would be spelled
Nutriskis, Nutriskis.com.
Okay. Yep. Awesome. I've already seen it. It's pretty cool. I like the website, and
I think you've tried a couple of the products, and I think you're pretty impressed with them.
I really like the cleaning products a lot. It's super safe. And you and I have talked about this, but for those of you that haven't heard this before. And I signed up through Mr. Bednarski, and I liked it well enough to invite him on this show. I will tell you this, I do not like to endorse products that I haven't personally used, that I am not fond of. Okay, so that's saying a lot because I'm pretty particular. And for cleaning around the general household cleaning, I just don't think you can beat it. So anyway, it's part of one of the products in the product line, and you can go to Nutriskis.com. Is there anything that you wanted to add to that?
I think you pretty much summed it up. I've been marketing these products for 35 years, so obviously I believe in them. And obviously it's a solid company. It's not a flim-flam scam or anything like that. So I'm pretty confident that if somebody wants to take a look at something that could give them an alternative source of income, it might be worth a few minutes of their time to take a look at that website.
Yep, I think so. Well, hey, Nutriskis.com, and they can also call you, and if they forget, you can also email me, and I'll email you Mr. Bednarski's contact information, and you can find out about that. So, hey, thanks for calling, and have a great weekend.
All right, you have a good 4th weekend. Thanks, Bill.
All right, I'll talk to you soon. Thank you. Yep. It's really the soap product. It's a great product, and there is opportunity there. I know a guy that actually signed up a couple of years ago to be a distributor for this oil company, and I'm in motor oil. It's expensive, but it is a really good product. And this guy it's unbelievable what he's done. He actually quit his job recently. He went from working at night and on weekends, and I got to tell you, this guy's like a bulldog. He gets his teeth into you, or a pit bull, rather. Gets his teeth into something, and he just doesn't quit. So he's built up enough of an income to be able to support his family. He's got 3 kids. In a couple of years working at night and on the weekends. So, yeah, these things, they're doable. They make perfect sense to me. I understand it. But the key is, you got to have a good product. If your products are not good, then you're not going to feel good about building a little distribution business. Anyway, back to the investment side. The investment side of the business. So I'm going through and I'm running through some scans. And I normally do this on Sunday night, but since I haven't been doing the Sunday night shows live for quite a while, just because my schedule hasn't really allowed me to, I thought I would take a few minutes at the end of each show and just going through the scans, looking at companies that look interesting. When I say interesting, what I mean is there are certain price patterns that tend to show up on stocks that go on to make big moves. Now, I will tell you this, a lot of them don't. This is not investing. This is trading. It's completely different. An investment is something I'm going to invest in, like a JCPenney, for example. I'm going to hang on to that until it reaches the target price that I have for it, which is the subject of that paper that I'm actually going to bring with me to the seminar on August 13th so that anybody that wants one can actually get a printed copy of. I just decided that right now. So that's an investment. A trade, on the other hand, is something where, okay, it's moving up, it's exhibiting a certain pattern. Here, I'll give you a name. Century Aluminum. CENX is the symbol. On Friday, it was up 8.85%. Now, me saying that, 2/3 of the people listening go, oh my God, it's too late. No, it's not too late. The stock just came up off of a bottom. It was actually under $3 at one point in time. Was $15 this time last year. Okay, so volatile, yeah, that's what you want. If you're going to trade, you want stocks that are going to move a long distance in a short time period, right? Because that's how you make money. Catching an occasional big winner. That's how it works. Okay, so Century Aluminum, CENX. If I were buying it on Monday, I would actually put the buy order above the high price that was reached on Friday, which it closed at, by the way, $6.89. And then I'll put my stop just below the low it reached last week, which was $5.64. Now, I would take the difference between the $6.89 and the $5.64, and I would take 1% of my trading account, and I would divide that number into that. I'm not going to do it right here. Just basically, you'd be putting your sell order in right below the low price that it reached about 4 days ago. So just remember that if you decide to take that trade. Now, don't put all your money in something like this. No traders. There's an old saying in the trading industry. There are old traders and there are bold traders, but there are no old, bold traders. If you're going to be bold, you're not going to get to be old because you're going to have to stop trading. You'll have lost too much of your money. So you don't want to risk more than 1%. I risk 0.5%. So I take 0.5% of my trading account's value. Let's say it's just $100,000. 0.5% is $500. Or let's say it's 20,000 because that's probably the more likely what most people should be trading with. So $20,000, 1% is $200. A half of that is $100. So if we're going to take $100 and I'm putting my stop about a what is that? The distance there, 9,560. That's a little over $1. Let's call it $1. Say I put my stop $1 away. Okay. And I'm only going to risk $100. That means I can risk 100 shares, which is not a whole lot of money. $689. Out of $20,000, that's not a huge percentage. That's not. It's a little over 5%, I think. Yeah, it's a little over 5%. So that's not a huge percentage. No, 5% would be 1,000. It's not 5%. It's about 2.5%, somewhere in that neighborhood. So it's not a big position, but here's the thing. If it goes down and hits my stop, I'm only going to lose $100 out of 20,000. Do you know how many times I can be wrong doing that and still not lose a lot of money? And that is the key. It's not being right. It's not losing a lot of money when you're not right. That's the key. Okay, so the trading aspect, that's what you want to do. Now, if the stock were to go up 10% in the next couple of weeks, I'll actually bring my position up. I'll add to my winners. Most people are already looking to take a profit. Bad idea. Look to add to your winners. Move your stop up. Keep your risk at no more than 1% of the principal. and then see how it goes. These stocks can move. The fact that I had 23 stocks come up on a scan that's actually fairly difficult to qualify for is actually pretty good, especially given the all the turmoil that's been going on in the past couple weeks. Normally, you might see 5 or 10 stocks on this particular scan because it's pretty stringent. You got to pass a lot of criteria to make it into this. So that's one of the things, and I like the pattern. The fact that it was up 8% in a day, that's not saying a lot because the stock's it's under $10. That's not saying a whole lot, but it's better than nothing. The volume was above average that day. It looks like it's coming up off of a multiple bottom, a triple, just crossed through, went through the triple bottom, and then just barrels right back up. So you're looking at support and resistance. It just took out the support and then rallied. And anybody that's been trading for a long time period recognizes that shakeout pattern. If you haven't been trading a lot and I've just confused you, don't worry about it. Not a big deal. Yeah. Fact of the matter is, and we'll talk about this probably about 10 or 15 minutes at the workshop because it's fun. Here's another one, SunCoke Energy Partners. Now, I'm not even sure what these guys do, and I'm pretty sure it doesn't matter anyway because this is a trade. This is not a long-term investment. I like to look at the price to sales ratio. It's 0.57. The average is 2 for the S&P 500. We just looked at Marathon Oil. Its price to sales ratio was 2. Here's a company that's also a commodities-based company whose price to sales ratio is 0.57. Okay, so it's 1/4 of Marathon. Has a cup and a handle pattern that's a classic. So if you know what that is, then you know exactly what I'm talking about. Was up 13% on big volume. By the way, at $12.30, it's significantly below where it was a year ago. So its bottom looks like it's coming back around. Those are the 2 stock picks for the day. Century Aluminum. Actually, make sure. Century Aluminum. Century. I can't read or speak today. And what was the other one we were just talking about? Oh, there was actually one I didn't get to. Key West Holdings, KEYW. Low price to sales ratio for the industry that it's in. But not necessarily overall. Price to sales ratio on that's 1.25. So those are a couple of the stocks. SunCoke, by the way, is SXCP. $12.30 is where it was. That's the one with the 0.57 price to sales ratio. So those are 3 stocks, 3 shots. Just don't risk a lot of your money on it. Feel free to call me, email me with any questions you have during the week. Hope your guys' week is really good. Hope you have a safe 4th of July weekend. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.